Hello and welcome to the third video for Accounting 205 Chapter 4. I'm going to start this video on page 4-9 and today we're going to discuss self-employed health insurance, health savings accounts, and moving expenses in this video. The self-employed health insurance deduction is taken on Form 1040, and if you go back and look at page X, you will see that it is listed there. All right, all you have to do is go and take a look at it. It is on line 29 of Form 1040. All right, there is no other special form for this. You just go there and you pop in the amount that you paid out of pocket, okay, for your self-employed health insurance. Now, just one thing, you're probably not going to see this too often. Most taxpayers are going to be covered either under a plan they have at their full-time job or under their spouse's health insurance plan. They may also have health care coverage under the Affordable Care Act, by going to, buying it, from the ACA website. Okay, so this is going to be a rare deduction. All right, let's take a look quick at the rules governing the self-employed health insurance deduction. Okay, number one, if you look at the top of page 410, if you are covered or could be covered under your employer's plan, then you're not eligible for the self-employed health insurance deduction. Okay, also, you are limited to the income on Schedule C. So if your business has a net loss, you cannot take the self-employed health insurance deduction, even if you paid for it out of pocket. All right. Now, one thing that sometimes the word self-employment is a little murky. Self-employment applies if you file a Schedule C as a sole proprietor, or if you file a K-1 as a shareholder in a subchapter S corporation, assuming active participation, or if you file as a general partner in a partnership, and again, of course, assuming active participation. Okay, all three of those are considered to be earned income. Okay, earned income, Schedule C or a Schedule K-1 from either an S corporation or a partnership. All right, there are some items on page 4-9 that tell you what is covered, all right, under self-employed health insurance. In other words, what is deductible, and you can read those 4 bullets at the bottom of page 4-9. Okay, moving on to page 413. All right, we have a discussion of health savings accounts. Okay, back to your 1040. All right, if you go look, your HSA deduction is on line 25 of Form 1040. Okay, so if you want to know if your clients have an HSA, one giveaway is that look at their W-2 form. Okay, go to box 12. That's where they put all these codes. All right, for example, code D for deferred compensation. Or code E, which I believe is deferred comp and you work for the government. Okay, but there's one particular one called code W. All right, code W. These are contributions that are made by your employer to your health savings account, your HSA. Do not make the mistake of deducting those and taking them as a deduction on the front of the 1040. All right, the contributions made by your employer are not deductible by you on your Form 1040. All right, you already got the benefit of the of the health insurance because your employer has already contributed to your plan for you. All right, so there's no deduction to take. You can't take a deduction for something that somebody else paid generally. All right, and also if you have made HSA deductions out of your paycheck, you need to check, or I'm sorry, out of your client's paycheck or yours, you need to check whether or not they're pre-tax. Okay, most companies that would offer you an HSA, if you make contributions, okay, then many times they're pre-tax, which means you already have the advantage of the deduction, so you can't double dip and take it again on your 1040. What you would put on line 25 is if you or your client made contributions to their HSA plan straight from their own checking account into the HSA. All right, now how would they do that? Well, for example, let's say somebody's got $200 in their HSA account and they get a bill from the doctor for $300. Okay, that means that they're $100 short. So what they would do is they would withdraw from their own checking account $100 and put it in their HSA. All right, so that they can pay the bill through their HSA. All right, well, that $100 that they would take out of their personal checking account would go on line 25 of the Form 1040. All right, and that's the only way it would happen. Remember, these deductions have to be out of post-tax dollars. All right, never pre-tax dollars, because you already got the deduction. Okay, at the bottom of page 413, okay, are some of the rules about HSAs. All right, first of all, if you are doing a tax return for somebody, ask them whether their HSA covers the whole family or just them, because there are limitations either way, and those limitations are shown at the bottom of page 413. All right, so the first one is the contribution. All right, if you have a family HSA, you can contribute up to $6,750, you and your employer. All right, but only $3,400 if it's self-only. If you're 55 or older, you can add another $1,000 to that. All right, HSAs are high deductible plans. That's the whole purpose of them. They're aimed at healthy people. Okay, the premiums are low because the deductibles are so high. All right, so the minimum deductible for a family is $2,600. The minimum for a self-only is $1,300. And then they also show you the maximum that you would pay out of pocket before everything is covered by the insurance company. All right, the distributions are mentioned on page 414. And basically there is, as long as you or your client is taking a distribution out of the HSA strictly for medical reasons, then you don't have to worry about any additional surcharge like it mentions on page 414. All right, you definitely don't want to take a distribution from an HSA for a non-medical reason, because you get hit with a 20% additional tax. But again, it's very rare you would ever see that happen. Okay, the last category is moving expenses at the bottom of page 414 and 415. All right, as of 2018, January 1st, 2018, the moving expense deduction has been eliminated. All right, and so we're only talking about 2017 now. All right, basically when you move, you had to have changed jobs, that's number one, and you had to have moved more than 50 miles, all right, from the distance between your old job and your old home. So let's say every day you go to work and you drive 10 miles. All right, that means that you had to move at least 60 miles away in order to qualify for the moving expense deduction. All right, well, what do you get to deduct? Well, you get to deduct, you're moving your household goods and your personal effects, whether that's with, a van line, or you did it yourself with a U-Haul, or, a Ryder truck or a Penske truck or something like that. Okay, all right, and you get to deduct lodging, but not meals. All right, if you're going to take the standard mileage rate instead of the cost of renting the van, then you're going to get 17 cents a mile. All right, and that's one way. All right, you only get this one time. All right, and again, if you go to Form 1040, all right, and look at the bottom of page 1, all right, you'll see that the moving expense deduction is on line 26. Line 26. Okay, the examples about those are listed at the bottom of page 415, I'm sorry, and it shows you how to deduct the moving expenses. That's the end of this recording.